In this video, we're going to discuss the treatment of deferred foreign income upon the transition to the participation exemption system of taxation under the Tax Cuts and Jobs Act of 2017. In this example, individual A is a U.S. citizen who owns 100% of FC, a foreign corporation. FC is a controlled foreign corporation that was formed on January 1st, 2013. FC has accumulated earnings and profits of $100 as of December 31st, 2017. FC is a specified foreign corporation because it is a controlled foreign corporation. FC has post-1986 earnings and profits of $100. All of the $100 of post-1986 earnings and profits is accumulated post-1986 deferred foreign income, or ADFI. Since FC's ADFI is greater than zero, FC is a Deferred Foreign Income Corporation, or a DFIC. For the 2017 year, FC's Subpart F income will be increased by $100, the amount of FC's ADFI. We will call this Subpart F income repatriation income. Individual A will be able to claim a deduction on his 2017 tax return the same year that he has the repatriation income. The amount of the deduction will depend on the amount of cash and other liquid assets held by FC at the end of 2017, the amount of FC's aggregate foreign cash position, or AFCP. If we assume that FC had cash and other liquid assets of $20, then $20 of repatriation income will be offset by a repatriation deduction based on a 15.5% rate, and $80 of repatriation income will be offset by a repatriation deduction based on an 8% rate. We will call the $20 the AFCP portion, and we will call the $80 the non-AFCP portion. Starting with the AFCP portion, the repatriation income is $20, less the repatriation deduction that we don't yet know, we have to calculate, will give us net repatriation income, which again we don't know because we don't know the repatriation deduction. We know that the highest corporate tax rate is 35%, and the tax needs to be computed with reference to that. The tax on the $20 must be equal to 15.5%, and we know that 15.5% of $20 is $3.1. So now that we have the $3.1, we can back into the numbers above. 3.1 divided by 35% is $8.9. Now that we know that net repatriation income is $8.9, we can compute the repatriation deduction. 20 less $11.1 equals the net repatriation income of $8.9. The 11.1 is a number we'll come back to. A simplified method of computing the repatriation deduction in the AFCP context is to multiply the repatriation income by 0.557. Now, addressing the non-AFCP portion with repatriation income of $80, less the repatriation deduction which we need to compute, which will arrive at the net repatriation income which we need to compute. We know the highest corporate tax rate is 35%, and we know the tax has to be 8% of $80, and 8% of $80 is $6.4. Now that we know the 6.4, we can back into the numbers above. 6.4 divided by 35% equals 18.3. Now that we know the net repatriation income is 18.3, we can compute the repatriation deduction, which is 61.7. We'll come back to the 61.7 in a minute. A simplified method of computing the repatriation deduction in the non-AFCP context is to multiply the repatriation income by 0.771. We know that the AFCP repatriation deduction is 11.1, and we know that the non-AFCP repatriation deduction is 61.7, so the total repatriation deduction is 72.8. The total repatriation income was $100, thus the net repatriation income is $27.2. Individual A will calculate the tax on this net repatriation income, and he can elect to pay that tax in installments over an 8-year period.